Chris Urso here with URS Capital Partners. Hope everybody is doing well. Let's see if I can get this figured out camera-wise. All right, I think that's a little bit better. Welcome. So I'm going to continue with our quarterly update. We really made a effort here to get it out in a timely fashion. Obviously, again, with a lot of the headwinds out there and headlines around our space, our job is to try to convey actual performance across our portfolio, across our markets, and just thought it would be helpful to share with everybody here, both our investor base and those of you that are considering investing with us in the future. So going to walk you through the same way I did last quarter. Got all kinds of URS gear on today. So got the URS Properties hats, our property management arm, new URS Cap t-shirts. Our investors are going to be getting these soon. They're pretty awesome. So, I'm going to go through, take you through the KPIs that we're tracking again on a weekly, monthly, quarterly, and annual basis. Just to give you some insight on what what our traffic is like, what our rent growth has been like on new leases, on renewals, the tours, the leasing velocity, our NOI growth, bad debt, basically all the major metrics that we're looking at across each one of the deals in our portfolio. And then maybe at the end, I'll just touch a little bit on kind of the market and what our strategy and approach has been right now in this environment. So hope you enjoy it. Feel free again to email us if you have any questions at info@urscapitalpartners.com. We'd love to be able to take you through it to answer any questions that you might have. All right, so I'm going to start same way we did. I'm going to work with, let's see, pointer. There we go. Same thing we did last month. So these are our deals that we have in the existing portfolio. Here we go. This does not include our student housing asset. That's kind of separate asset class. That deal's running at 100%, 99% leased currently, 100% pre-leased for the 23-24 school year. That's 750 beds, 255 units in Murfreesboro, servicing MTSU University. It's all cottage style, top of the market product for that particular school and sub-market. So super happy with that. This is purely our multifamily assets. So over here you have Latitude at Richmond Hill. This is suburban Savannah, Georgia, in Bryan County. Excellent school district. We've had the deal. It's going to be pushing up on 4 years next month. We bought it just at completion. It was only about 50-60% occupied. We've since increased the rents by probably close to $600 since takeover in 4 years, and stabilized occupancy, refinanced the asset. Great asset, great submarket, great tenant base. So let's jump into the metrics here. So for the month, for the quarter, Q2, we had 139 leads. Again, just to recap, leads are any form of inquiry. So that can be online listings, phone calls, drive-bys, text messages in some instances, you name it. Any form of lead. 139 leads turned into 60 tours, 25 leases. For the month, these are approved leases for the month. There we go. Okay, that's much better. So we closed out the quarter at 92.3% occupancy, down, and this is in place physical occupancy, down a little bit from the close of Q1 at just shy of 95. We closed at 92. So we went down slightly on Richmond Hill. Crescent Place, this is 232 units, Savannah, Georgia. This is a massive reposition. If you don't remember, we've had the asset now for May, June, July, just 15 months since takeover. We bought it from a very long-term owner. They had it for 25 years. We executed just shy of a $5 million renovation program, which is complete. We're just working on interiors at this point. Full rebranding of the property, all new exterior paint, gutters, landscaping, signage, rebranding. Gutted the entire 4,000, 5,000 square foot office maintenance, leasing center, whatever you want to call what it was, to convert it into a true leasing center, clubhouse, state-of-the-art fitness center, and laundry center. Property shows extremely well. Redid all the pool areas, added outdoor grilling stations, dog park, etc. So we're still in the throes of renovation, only 15 months into it, but we've had tremendous results here. 274 leads, 74 tours, 24 leases, a little bit less than we'd like to see on a conversion ratio. This is more of our kind of workforce gray collar housing product in our portfolio. So you tend to get a little bit inconsistencies in qualified traffic, right? Especially as we're still going through the rebranding of the property. A lot of times when we buy the older assets that we're going to reposition and rebrand, people within the market have a perception of the property because of what it was and where the rents were at the time. So they'll still come into tour thinking that the rents were $900. Meanwhile, today it's $1,500 because all the capital we've invested into the asset. So we closed out the quarter strong on occupancy, up pretty meaningfully from the last quarter. And again, at the end of this presentation, I'm going to give you guys today's actual leased occupancy as of 4 days ago, actually, when the report was done. So Latitude South Portland, brand new development. It's now touching up on about 2 years old since we've completed. Tremendous amount of traffic and tours resulted in 41 leases for the quarter, very strong. Occupancy very strong, see up a couple hundred basis points, but very strong leads, demand. Seasonality is real in Portland, Maine. There's not a lot of leasing and movement, obviously, in Q4, beginning of Q1, given the climate and the weather conditions and the challenges there. So that's, it's not uncommon to see this amount of traffic come through in Q1. Exchange at Rock Hill, brand new development in Rock Hill, South Carolina, suburban Charlotte. Really beautiful product. Really ratcheted up our online marketing presence, so driving a ton of leads, ton of tours, just shy of a 50% close ratio that we strive for as a benchmark. But again, awesome quarter. So across 3 months, 52 leases, really strong, averaging, just over 17 leases per month. And we're knocking on the doorstep of stabilization here. We're 76% occupied, meaningful jump in occupancy quarter over quarter. Then we have Farmhouse Apartments, which is another new construction product, Nashville MSA. Another big, we're really focusing a lot of attention on our online and digital marketing. So I encourage you to check out our websites for the Exchange at Rock Hill and for Farmhouse Apartments. We're doing a lot of paid traffic, paid search, digital, social advertising to drive that traffic. We also had our grand opening, which was a huge success. It's another reason for a lot of these tours. We had close to 100 people at our grand opening alone that registered with us. Obviously, these were members of the community, other business owners, chambers of commerce, etc. But it was a huge success. Very happy with that. Really strong growth in occupancy for the quarter. You can see here 73 leases. That's over 20 leases per month, which is fantastic. So again, happy here on our momentum and want to keep that going. So now we'll talk a little bit about our amount of move-ins for this quarter versus last quarter. So we're going to go in consistent order here. We had 18 move-ins at LRH, which is consistent with the first slide in the form of traffic and leases. So slightly down on move-ins. Crescent Place was up pretty meaningfully. The other thing here, these are the average increase on rents over the prior rent on that same unit. So Latitude Richmond Hill, meaningful double-digit rent growth, almost 15%. Crescent Place, monster growth. Obviously, this is a result of our value add program. That's not organic growth. That is forced rental growth. We bought the property with significantly below market rents. We've invested capital to generate that type of rent growth of 34%. But strong move-ins. Portland, Maine, extremely busy month, as we touched on earlier. 41 new move-ins, just about 5% growth on those same units, meaningfully up over the prior quarter as well. Exchange at Rock Hill, 40 move-ins versus prior quarter. And this is just the average rent on this. Actually is a zero, because these are new units, first generation leases. So that's a zero. 52 move-ins at Farmhouse Apartments. Very busy. I mean, our teams are doing a fantastic job, folks. If you think about the moving parts here, and the attention that we have to give, the amount of traffic that's coming in the front door, right? Doing tours, following up on leads, etc., dealing with closing out of construction on buildings and punch outs, and then managing 52 apartment move-ins throughout the course of the 3 months as well. Excellent job by all of our teams across the board, as you can see there. And then we'll touch on renewals here. So we had 27 renewals at LRH, 24 move-outs. So we netted, we're above, which is good. 5.7% increase on renewals. That same unit. So obviously, if a tenant was paying, $100 last month, and they renewed now at $105, for an easy example. So 17.6% increase on renewals at Crescent Place. That's really strong for that profile of deal. That shows us that the tenants are appreciating and valuing the renovations that we're doing at the property level, and they want to stay in their unit, and they're willing to pay for that improvement. Latitude at South Portland, kind of steady Eddie. We had a lot of expirations, as you can see here, between the two. So 76 expirations in Q2. So we manage expirations carefully, right? Because we want to keep occupancy strong. We did over a 50% renewal rate, which is great. Average 2.7% increase on renewals. Kind of the norm for a stabilized property. We just had a bunch of exposure. I expect that's going to be stronger in Q3 because our occupancy now is so strong. We're being a little more aggressive on the renewals, between 4 and 5%. Exchange at Rock Hill. Our renewals are our first generation tenants from last July are now first move-ins are now expiring. And given that we're still working our way towards 95% occupancy, we have to be really smart on managing both the front door for new traffic, getting new leases in, but also keeping the back door closed and keeping our residents in place that we have. This property, we had meaningful room and cushion on our rents. We way outperformed our projections because this was built during COVID. So all of our assumptions were based on 2019 rents, and we started construction in 2020. So we saw material growth in rents, obviously, from 2020 to 2023. So we have a little bit of flexibility to not be as aggressive till we hit our 95%. Then we'll get back to our normal 2 to 3%, maybe 4 or 5%, depending on the market for renewals. But we're not trying to be aggressive. We're really focusing. As you can see here, we renewed 31 of 36 expirations. That's a fantastic job by our team. And it takes really hands-on management. The last thing you want to do on a new development lease up is, put yourself in a position where you're still leasing out your last building and your first building's expiring, and now you're losing tenants in your first building while you're still trying to fill out your last building, and you're kind of stuck in the mud. So again, good job there. 4 move-outs at Farmhouse Apartments. I am going to touch on that because that's something that you have to be aware of when you're leasing, and we have this many leads and tours and the velocity that we've had at Farmhouse in the last 2 quarters. A lot of folks are leasing sight unseen, for units. We do our best through virtual tours and backgrounds and videos and pictures, on the property. But somebody's coming in from Iowa or California or, another part of the country, and they move into a unit. We work with them. If something's not working for them, we're not going to force them to stay in the community. So it's not uncommon on a new lease up to have a handful of move outs within the first 30, 60 days. We want to be sure of that that's not an inherent issue, right? And people aren't moving out because it's a property issue. It's more of a lifestyle issue or a location challenge that people underestimated a commute or the size of the unit and the amount of stuff that they have. So bad debt here, Latitude, Richmond Hill. This is something to pay attention to. Across our portfolio, we monitor it closely. More bad debt at LRH, more bad debt than last quarter at Crescent Place. Both of those are the result of LRH was basically one unit that finally was able to be evicted. That was carrying a large balance that kind of popped that. The majority of, I'd say almost half of that write-off came from one unit. Sorry about that. Uh, that was finally able to be evicted in this quarter. And we don't take write-offs until the eviction actually happens. So if it takes 2 months or 2.5 months, it depends on where the month lands, right? Where the timing is when that tenant gets evicted is the month we take the write-off. And again, for write-offs, as I touched on last update, it's not just rent. We include damages, late fees, penalties, breakage fees, etc. in that number. So nothing too alarming relative to the size of these deals and the GPRs, the gross potential rents on them. No major concerns. You see, South Portland had no delinquency. Exchange at Rock Hill, $434. $673 at Farmhouse Apartments. That was likely some application fees or something along those lines, or late fees that we chose to write off. And then for what are we looking at here? So NOI for the quarter, LRH down slightly from last quarter. Combination of two components. Vacancy was down as we saw earlier. Vacancy was up, right, as we saw earlier. We were at about 92, 93% at the close of the quarter versus 95 prior quarter. And we also had a utility accrual that hit this quarter. That basically, the bill actually came in this quarter on a handful of vacant units. So it was mainly utilities and vacancy. Crescent Place moving in the right direction for our business plan here. Pretty meaningful growth in NOI quarter over quarter. Latitude at South Portland, meaningful growth quarter over quarter. There's a lot to do now that we're moving out of the winter season. The winter season runs heavier on expenses, and our occupancy is also up. So expenses are down, occupancy is up. Exchange at Rock Hill moving in the right direction as well. A really good place. Farmhouse Apartments moving in the right direction, right? We're still negative, but the negative is less than last quarter's negative, right? So on new development, you're in lease up. The goal is to get as many units filled as you need to hit break even on operations, right? And then the next goal is to hit break even on your debt service. So we're making our way there. We're moving in the right direction. And then this column here represents our rolling T12 NOI versus the previous 12 months of NOI. So meaningful increase in LRH. Crescent Place we've only had for 14 months, so we don't have a year over year comparison. Latitude at South Portland significantly up. This is our first full year of operations that we're completing. So really strong NOI. Exchange at Rock Hill, again, we're in our first, approaching our first year of operations. And then Farmhouse Apartments has nothing to compare to either. So here's just a recap on both in-place average rents across the board and our current leased occupancy as of July 7th. So first, we have in-place rent at LRH for the prior quarter is $15.81, closed out Q2 at $16.74, positive movement, $13.44, $13.88 at Crescent Place, positive movement, $21.67 to $21.97 at South Portland, positive movement, $16.66 at Rock Hill to $16.88, $16.75, $16.74. Farmhouse, it's going to bounce around. We're not increasing rents there during the lease up at this moment, although I shouldn't say that because we just increased our 3 bedrooms because of limited availability and our 1 bedrooms. So that's going to be depending on what units are being filled. With such little occupancy, like Farmhouse, that number is not really a good tell on where rents are moving, because if we have more 1 bedrooms occupied at any given moment, that average rent's going to be a little bit lower. If we have more 3 bedrooms occupied at any given moment, it's going to be a little bit higher. But once you start accumulating more occupancy, we'll see that number kind of, trend upward, quarter over quarter. And then occupancy wise, as of July 7th, Latitude Richmond Hill, as you can see here, we closed out Q2 at 92%, 97% leased. Crescent Place was 95, 97% leased. Latitude South Portland, 98% leased. 100% leased to 98. Exchange at Rock Hill, 76 to 84. Farmhouse Apartments, 23 to 35. So what that's telling us is we continue to see strong demand for leasing. Seasonality is back. It's real. We're seeing great traffic coming in to our properties. We're really trying to take advantage of this through July, August, September, October, before we hit the holiday season, and capture as much occupancy and rent growth as we possibly can across our deals. Again, I touched on the markets that we're in. So, what we're seeing, that's kind of the operations front. What we're seeing on the opportunity front and acquisition side, not too much that we're super excited about to buy at the moment, but very exciting news on our Asheville development. Actually, as of this morning, we just cleared our pre-construction meeting with the county and the city and our GC and our site work contractor, and we are starting work next week. So super excited about that. We've got our permits in hand for all of our site work. We're submitting our vertical permits in the next 2 weeks, and we're off to the races there. And North Carolina, if you didn't see CNBC this morning, North Carolina was voted the #1 state for business for the second year in a row with higher ratings than last year even. It was awesome to see they actually had the Biltmore in Asheville, North Carolina, highlighted as they made the announcement. So very excited for the long-term prospects of that project and that market. But overall, I could say our business plan right now on the acquisition front is really where we're seeing a lot more deal flow. So a lot of deals are getting marketed, a lot of opportunities are being presented within our markets, and basically we are underwriting anything and everything that we possibly can that fits the profile of a deal that we'd like to own in a market that we'd like to be in for the long term. And we're underwriting to a number that we feel makes sense to take the risk today. We're being told no in almost every instance on our price, but we're building out a pipeline and we're collecting data through this, right? So we're tracking deals very closely through the process. We're getting some phone calls already that deals that we were told no on a month and a half ago have just fallen apart. Are we still interested? I think the common theme is that we're looking at it very similarly to groups that have been around for the last 10, 15 years like we have doing this. And there's a pack of us that are here on price, and then there's still a very small chunk of buyers and capital that seems to be significantly higher in the bidding process than the majority of the pack. So we have great relationships with a couple of other operators in our space that we share ideas on, views of the market. So I don't think we're missing anything. I think we're really trying to be patient. We're building a data set. We're getting more calls on random distress situations that aren't quite yet that intriguing to us at the price that's being addressed, but there's real distress there. Property's 38% occupied. They've had it for 3 years. They've ran out of an interest reserve. Lenders not funding CapEx in another instance. So we're seeing glimpses. I had this conversation with one of our good friends and a lender this morning. We were talking about all the different things that he sees on his front from loans that were originated through his firm and borrowers, and how he's working with them on refinances and how everything is a battle. And then the calls that we're getting from brokers and other owners. Do we want to look at this? Do we want to look at that? Where we know something's happening. We don't know to what extent, but it's a lot different than it was a year and a half ago. And the reality is, with the 10-year hovering around 4%, refinancing is not easy to get out of these short-term bridge loans, just to pay off the existing debt. Forget about taking equity out. We have a new analyst here at ErsCap that we're excited. He comes from Signature Bank. He's got a portfolio analyst background and credit background. We have him underwriting 103 deals that I identified within our markets that are maturing in the next 12 months, and we're underwriting them based on market rents, We're doing the tax work. We're putting the expenses in there. We're trying to get to a stabilized NOI. And then we're putting a 6% interest rate on the new loan and seeing if it can qualify to pay off the existing loan. We've done about 25 so far. Out of those 25, I'd say more than a third are in the 0.8 to 1.0 debt cover to pay off their existing loan. Now some of them still have another 6 months or 9 months to grow into that, but some of them are at literally 0.6, 0.8, 0.9, where it's going to be a real challenge, and the maturities are coming within the next 3 to 6 months. So we're going to get through all 103, and then we're going to create a really targeted list to follow and track. For those of you that aren't investors and looking at this on LinkedIn, you kind of get an understanding of what our thesis is. And then we do think that there's still opportunity in new development. It's a challenge. We are looking at some other sites. We have one site in addition to Asheville that we've had under contract for 18 months now. And we worked through some zoning issues with the city down in Mooresville that we're pretty excited about. We should have clearance on. We're very excited about. And then we have another site that we are really excited about in the suburban Charleston MSA, where there's a moratorium. It's a very challenging environment to get approvals, located in probably the single best school district in Berkeley County, where a ton of growth is happening. And it's going to be a challenge, hands down, to underwrite given the cost of capital and the amount of cash that's going to be needed. But we know that there's a really strong opportunity here if we can put a 5-year hat on very, very bespoke development opportunities, a 5 to 10-year hat, that there's going to be a lot less supply delivered post 25, moving into 25, 26. All the data points to, peak supply happening late 24, all through 24 and the beginning of 25, and then a material decline. And if you can muscle through, we think that there is going to be some unique opportunities on development. But our bread and butter is where we're most excited. Our goal is to go out and acquire 2,000 units over the next 12 to 18 months should the opportunities present themselves. So if you're interested in learning more about upcoming opportunities, please reach out to us. You can email us at info@urscapitalpartners.com. If you'd like to learn more about upcoming opportunities to be put on our list, Rebecca will do an intro call, make sure you're qualified, and we can go from there. But we're pursuing a lot of different channels right now to stay very close to the market, whether it's looking at distressed sales and sponsors, loan maturities, potential development where sponsors have a piece of land that's entitled but they can't put together the equity or get the debt in this environment, to also looking at potential note purchases on very specific type of product, meaning we're looking at some small local regional banks that would potentially be interested in selling some of their construction debt. So we have a lot of angles that we're working to stay as close as possible to this market. We've positioned ourselves in a very strong position over the last 3 years in an effort to be prepared to play offense when the time comes. We sold over 10 assets between 2020 and 2020, the end of 2022. We have less than 1,600 units in our portfolio right now. It's the smallest we've been in the last 10 years. We've got the most amount of staff that we've ever had and the largest infrastructure that we've ever had in our history. We brought on Quentin, as I just referenced. We have an executive regional manager that we just brought on that's got 20 years of experience. She's been a tremendous asset in the short period of time that she's been with us. So we're really excited between URS Properties and URS Cap. We are ready to go, and I hope you enjoyed this update. For those of you that are investors, you'll be getting your full quarterly updates here in the next couple of weeks as well on each asset that you're invested in. And any questions that you have, feel free to email us at info@urscapitalpartners.com. Thank you.